Hi folks, Scott here, and this is the wrap for Thursday, July 18th. So an interesting day today. We broke higher but finished weekly, and I'll talk more about that in a moment. But a couple of things stand out going into tomorrow that I'll be considering and evaluating for our members. And actually, I'll be discussing live and showing live at the Money Show. If you go to the Money Show E-Trading Expo, Money Show E-Trading Expo, you can see me trade live tomorrow from trading the gap and the 15-minute ranges, or evaluating them and trading them if applicable, between 9 and 10 a.m. Anyhow, this morning we had an unfilled up gap, or we gapped up and we never filled it during the course of the day. So going into tomorrow, you're going to have two consecutive unfilled up gaps. Tomorrow is Friday of options expiration week, so it's options expiration day. That's another consideration. We ended up with an inverted hammer. So if you look at a daily chart, open and close were in, I calculated less than 40% of the 5-day ATR. Let's see, we did end up though with a 200-day high close on the cash index and probably the futures too. And all of those will be covered in my pre-market comments or in our worksheet. Worksheet's going to cover most of them. Today's gap play worksheet will be posted around 6 p.m. tonight. But going into tomorrow, what I want to show you is something that happened at the end of the day and that impacts tomorrow a little bit. See that big yellow bar right there? This is the 5-minute chart, the E-mini S&P 500. That was the announcement of Google and Microsoft after the close. That may have just been Google, I'm not sure. But we closed at a 4 p.m. closing price. So the cash index, where the futures were trading when the New York Stock Exchange closed, was 1684.75. The top of this bar, 1684.75. The very next bar, the market tanked, and we closed and finished at 1680.75, which is right there. So that's a 4-point closing variance, and that's actually a pretty big deal, more rare than you would think. In fact, I just ran it for some members in our trading room at the end of the day, and just using the looser parameters of a 3-point closing variance to the downside when above a 10 and 200-day moving average has only happened 10 times in 11 years. 3 of 6 on down gaps, 4 of 4 on up gaps. So that's not a big enough sample size to trust. So I loosened the parameters to look at any time you're above the 10 and 200-day moving average and you sold off more than 2 points in the last 15 minutes. So closing variance more than 2 points in the last 15 minutes. And let me show you those results. Actually, I'm going to show you above the 20 and 200. Very similar to above the 10 and 200, but the last test I ran was above the 20 and 200. Very similar to the 10. A couple things stand out. Odds favor a gap up in this scenario historically. And a gap up historically using an end-of-day stop has been very attractive. Not likely to end up with a lot of selling pressure if you gap up, and does tend to fill the gap. So these are really strong numbers if we gap up. However, if we gap down, not the case. Only 6 of 14 let me double check. Filled their gaps. 0 is my gap target. Yes, that means gap fill. So only 6, 14, 8 did not fill the gaps and ran against you. Now there's one sizable loser there, about 10,000 using 10 contracts. That's still 14,000 on the other 7 trades. This is a steady loser and a gap down. So this shows me a risk factor that I think is worthy of noting, because directionally both of these favor a end of day bias to the downside, right? Do the math there. It's 31 of the 41 trades closed down below their open by the end of the day. So that's a pretty good number on a pretty unique and specific pattern in the marketplace. All right. Again, I'll consider Friday OPEX and inverted hammer and 200-day high close and all that going into tomorrow in my morning comments, and I'll actually share them live again for free at the E-Trading Expo at the Money Show. So be sure to sign up and come see me. Or tell them we'll be in the trading room to help out our members. Let's see. Let me show you today's action on the worksheet. We gapped up between the high and the, so just inside of yesterday's high. So it was not above the highs, between the high and the close. It was up in the DH zone, DHO zone. I mean, the prior day was down. We did close down between the high and the open. And this is just a neutral setup. If you look at the actual gap guides, which I'm not going to do, they would show you the DHO zone was actually neutral to weak. Neutral to weak. Because remember, this worksheet is an average of all 8 indices. So that was a concern. It was neutral at best, really neutral to weak. Thursday of OPEX during a bullish market has been positive historically. That's good. Same with after an unfilled up gap. That's good. But the short-term technicals, the guides that I count on the most, were not favoring the setup. And my other analysis was a little bit mixed. So last night's video also showed another positive, pretty compelling positive. But when I peeled the onion back on Thursday of OPEX week, even though it's very good, things like multiple successive daily highs, 100-day high in this case, only 5 of 9 wins, money loser. Small sample size, but still it didn't confirm the setup. Let's see. Up gaps after the last 3 daily highs were within 2 points of each other. This was interesting. It all really depended upon where the gap opened. Now, we opened just underneath this, but it was close enough to this much lower win rate that I did consider it. So bottom line is, I just said even the future sell-off summoned the open and the ES opens in the higher probability DOC zone, which means less than 1677.50, less than yesterday's open. The Nasdaq should be gapping down, not up. So you have opposing gap directions, small gaps. I don't trade those. Plus, there are only 3 of 8 indices favoring the DOC zone. So I just passed. That was an overall pretty easy decision for me. Not a bad setup, just not a compelling one. And that was a good decision because the markets ran after the open to the upside. And they ran pretty darn hard. Look at that move. The open right there, 1370, 875, ran straight up over 10 points. Russell ran straight up. Nasdaq was the weird one here. It actually gapped down, took some heat, and then once it the selling pressure abated there, the rest of the markets rallied, and then the Dow ran straight up too. So great call not to fade the gap. Would have been stopped out on that. The 15-minute range guides came out, and at that point, if we'd broken through the 3-day highs, and actually the all-time highs, we were trading 1681.75. Let me show you. This is a great example of a great way to use the range guides. And sure enough, they confirmed the high breakout. See the high breakout numbers here? Average of my 3 systems, weighted average, about a 60% win rate and a 1.2 PF. That means it's made over 20% more in profits and losses, so it meets my minimum criteria. And that may not sound like much, but when you get that consistently across most of the indices, in real world, it delivers better than that. Neutral in the YM, though it clearly leaned that way, it was better for the high break and the high fade. Same with the Nasdaq. Russell clearly favored it. ETF, Spider strong numbers there, Diamond strong numbers there, neutral in the Qs, and strong numbers in the Russell. So 5 of the 8 met the criteria. The Nasdaq was a concern to me, but we're above the highs. It was just sort of too good not to take, was my view on that. So took the 15-minute high breakout in the ES and the Russell and caught winners in both. Nice, easy trades. The first hour guides came out. They also, for time's sake, I'm not going to show you, they had very similar numbers favoring the high side. In fact, even slightly better numbers for the high side. But we were stretched to the upside. The advanced studies that are available on our website for a small additional fee that study these different range trades showed that I think there were 5 risk factors off the top of my head working against the high breakout of the ES today on the first hour range. So I was only going to take the high breakout, even though the data was good, on a pullback at 84, which is what I did, and it being a great decision. The Russell I set up to get filled on a pullback, but also set up part of the position to right at the level here with a tight stop, only a 1-point stop. Just knowing that we were due. In fact, I called it out perfectly today. I'm not trying to brag, but today I was right. Thought there was a good chance we'd come up here and test this 1052 area, which I think was R3, and it went to 1051.90, 1 tick from it. So caught a nice another 2-point winner there, 2 points earlier, 4 points in the ES. Delayed my entry on the ES. Went up 3 points, triggered my proximity rule on the first hour high breakout for my delayed entry at 84. At that point, coming late in the session, because my proximity rule had triggered, I didn't want to risk a late dump, which sometimes happened on Thursdays of options expiration, plus the Nasdaq was trading below the close. So I closed the first hour range trade for a scratch trade. Went long about 10 minutes later as we appeared to break higher into the close on my gotcha setup, which is explained in our members forum. I traded when we have an unfilled up gap and with a stop just below the low there, and I lost 2.25 points on that. So several winning trades today, or scratch trades, and I gave back a little bit here on the gotcha. I did tell people would not trade aggressively. NASDAQ was a flag here. Gotchas work best when all four indices have not filled. And NASDAQ not only filled, but it was trading weekly that into the close. I think that was, again, Google earnings that just blew it out to the downside. So the good news is, again, it could set up a good setup tomorrow for shorting an up gap. But a little bit premature in that, but just thinking ahead to options expiration Friday. So I think I've covered everything. Yesterday was a frustrating day. Today was a much better day when I made up what I lost and then some. So that's why you just got to have short-term memory, trade your setups, and over the long term it works out. Have a good one. We'll see you tomorrow.